Hello everyone. Thank you for your attention. My name is Darna Brandon. I'm the Congressional Liaison of the Asset Building Program to the New America Foundation. I would like to thank everyone for coming here today. The turmoil that we're seeing in the mortgage market highlights an important challenge to the American dream of homeownership. How do we make sure that those who enter into homeownership are actually able to sustain that status? The goal of today's event is to look beyond the mortgage market meltdown and offer novel solutions and improvements to proven programs to boost savings and encourage asset building through sustainable homeownership. We are hosting today's event in association with the Savings and Ownership Caucus, which has the mission to explore and debate policies to build savings and assets for all Americans, especially low-income Americans. The co-chairs of this bicameral, bipartisan caucus is Senator Conrad, Representatives Cooper, English, Petra, and Pomeroy. We're actually going to be hearing from Phil English today, and he's a House representative from Pennsylvania, and he was reelected in 2006 to his 7th term to serve. In his first term, English became the first freshman Republican to be appointed to the Ways and Means Committee in almost 30 years. He now serves on 2 subcommittees on Ways and Means, Select Revenue Measures and Health. Congressman English is a founding member and co-chair of this Congressional Savings and Ownership Caucus. Please join me in welcoming Congressman English.
Thank you. It's a real privilege to be here, and it's exciting to see this program go forward. It's a particular honor for me to be able to join leaders from the New America Foundation and experts from financial services and the housing sector to discuss innovative solutions and improvements to programs that will help boost savings and encourage asset building through sustainable homeownership. Today, there's a profound and growing sense of uncertainty among middle-class Americans as they work toward their retirement, with fewer and fewer workers actually covered by defined benefit pension plans, an all-time low in the national savings rate, and longer life expectancies. Middle-class Americans are struggling to adequately prepare a nest egg that will sustain them through their retirement years. In my view, today's event, which will focus on a series of policy recommendations for increasing financial security for middle-class Americans, comes at a particularly critical time. Our country is facing a quiet crisis, with more than 77 million baby boomers preparing to retire in 2008. Washington must prepare the challenges for the challenges of retirement security. We have to be able to move forward with creative new policies that will broaden the scope of retirement savings and ensure economic security for working families in different communities and under different circumstances across the country. Over the past 2 years, I've had the privilege of serving as one of the 4 co-chairs of the Congressional Savings and Ownership Caucus, which is a bipartisan, bicameral coalition that's been on the forefront of promoting policies to expand savings and asset ownership in America. While our caucus has supported an eclectic variety of legislative initiatives to improve the use of savings vehicles, I'd like to briefly highlight legislation that I've been working on with Representatives Stephanie Tubbs-Jones and Joe Pitts. This Congress, we're working together in pushing bipartisan legislation to expand individual development accounts, which are, in my view, one of the most promising tools for enabling low-income families to save, build assets, and enter the financial mainstream. In my home state of Pennsylvania, we have more than 50 IDA programs that have helped more than 6,000 Pennsylvania working families prepare for their future. To ensure savings among these families, the Savings for Working Families Act creates, for the first time, an actual federal tax incentive for financial institutions to match savings of up to $500 for qualified low-income families. This initiative is a solid example of common sense legislation that Congress can adopt to help encourage savings and open the door to allow more American working families to develop a lifelong asset, such as buying their first home. Instilling in this and the next generation the importance of saving for the future is the best way to promote economic stability for America's working families and improving the fundamentals for growing the economy. I look forward to continuing to work with the New America Foundation and with my colleagues in the Savings and Ownership Caucus and with the experts to continue to boost the cause of building an ownership society based on savings and assets. This is, I think, an important objective. I'm happy to say it's shared by leaders across the political spectrum in the House, and it's my privilege now to introduce one of these. Jim Cooper, when I was coming into the House, was just leaving the House as a very senior and very distinguished member. After a hiatus of a number of years in which he was teaching at Vanderbilt, the people of Tennessee sent him back to the House, where he has served as an invaluable bridge between people of both parties who are committed to break the mold policies. With that, I'd very much like to turn this over to one of my most distinguished colleagues, Jim Cooper.
What a kind introduction. I want that tape recorded. I need you everywhere.
Anytime.
Thank you. Well, it's a true pleasure to serve with Phil. He brings so much not only to his power committees, but also to gatherings like this. Thank you for taking out time from your lunch hour today to hear the New American Foundation and Savings and Ownership Caucus presentation. Couldn't be more timely. You know, we worked for 2.5 years as a caucus to try to help people add more eggs to their nest. My wife's an ornithologist, so maybe I can continue this egg analogy. Not an orthodontist. I wish you were an orthodontist. That actually makes a lot more money than an ornithologist. But it's birds, not teeth. We worked hard to try to add eggs to the nest. We were on the offense. But now, sadly, we're on the defense. Because the biggest egg in the nest, by far, is cracking. The equity in your home is challenged. Increasingly, and we're going to be reading much more about it even than we have been so far. An estimated 2 million teaser rate loans will be ratcheting up in the next year or so. A lot of folks who signed those agreements are not aware of the implications. Foreclosures are already up over 100% from this time last year. They're increasing monthly. They affect different parts of the country in different ways, but for people to have saved by paying their home mortgage and then to risk losing everything is a truly devastating blow to the savings ethic we're trying to create in this country. So it's a challenging time. It's tough to be on the defense, but we need to do the best we possibly can to keep home ownership up. What I think it peaked at about 69% and not let it drop down to more traditional levels in the mid or the low 60s. We're fortunate in this country because we have the most developed mortgage markets in the world. It's hard to believe, but in some first world countries, you cannot get a 30-year fixed rate mortgage. You know, we so have taken that for granted in this country that we've added bells and whistles and perhaps some devices we shouldn't have added to our mortgages in order to enhance the market. So it's a truly precious thing we're trying to preserve. It's your nest egg. It's America's savings rate, because the critics of folks who said, well, we really are saving quite a lot because we have tons of home equity, that itself is being threatened right now as home values in many parts of the country decline. So it couldn't be a more timely topic. We have great experts here. Let's learn. Thanks.
Thank you very much. Thank you, Congressman English, Congressman Cooper. Thank all of you for coming. It's really terrific to have such a big turnout, and I really want to thank my panelists for agreeing to be here today. But, you know, the focus of Congress, the press, the administration has been on the current problems in the mortgage market. By the way, I guess I should tell you who I am. I know, it's exciting. I'm the director of the Financial Services and Innovation and Education Project at the New America Foundation. We try to be innovative. And we're just really very excited to have you here today. The focus has been on the current problems in the mortgage market, and the broader capital markets and economy, and what will happen to the people in communities where house prices are dropping and closing, and loans are foreclosing. This is a perfectly reasonable focus. The problems are serious. They're going to get worse. As Congressman Cooper said, about 2 million households are going to be affected by rate resets. Since most of these loans were made at teaser rates, a 0.5 percentage point change in the federal funds rate is not going to make a huge difference. Those loan payments are going to go up, and they're going to go up quite a bit. And of course, it won't affect be much benefit to those who can't meet their house payments for more traditional reasons like death, divorce, disability, or unemployment. Congressman mentioned foreclosures are up 100% over last year. From foreclosures in August, they're 115% up over foreclosures last August, and they're up even 36% from July. Places that are hardest hit are those where there was a big run-up in house prices between 2000 and 2006, and then a significant drop. For example, California is number 2 in foreclosures. And in Los Angeles, real house prices went up 135% between July 2000 and July 2006, and have dropped 5.1% since. But at least for now, many of those states, such as California, Nevada, and closer to home, Maryland, which is number 14, and Virginia, which is number 17, have quite strong and robust economies. The other group of hardest hit states, like Ohio at number 5, Michigan at number 6, and Indiana at number 10, had slower price appreciation, but they've nevertheless been hit with declines, and their economies are struggling with high unemployment at the same time. Which means that when people get into trouble, they're not going to be able to get out by selling or refinancing. And this brings us to an important point. One big thing that went wrong in this entire episode is that everyone involved came to rely on housing as a can't-fail investment, when in fact housing's record has been much more modest as a general matter and quite susceptible to regional booms and busts at particular times. Our national personal savings rate dropped to below 0 in 2005 and has stayed there. But as Congressman Cooper said, some people excused it as, well, that's okay, the equity's in the house, the savings are in the house. But at the same time, the equity people had in their houses dropped from 70% in the 1980s to 57% as recently as 1999 to 54% in 2006. Now, given that about 1/3 of homeowners have no mortgage, which means they have 100% equity, that suggests that many of the rest of us were using the investment value of housing not to save, but to spend. Over the past 60 years, homeownership has indeed been how Americans built wealth. But in the past, it's been a relatively slow and steady buildup, consistent with the shelter and stability aspects of ownership. Both borrowers and lenders have the same goals. When that focused and unity of interest is lost, the door opens wide for both abuses and delusions, both of which have been in strong supply over the last several years. What we're going to do today is attempt to look backwards a little in order to go forward. We're going to consider how to get homeownership back to being a way to build assets smartly and sustainably. We'll hear first from Conrad Egan, who's the president of the National Housing Conference. Conrad also served as the executive director of the Millennial Housing Commission and is currently serving as the chairman of the Fairfax County Redevelopment and Housing Authority. He's an expert on housing of all types, with a special expertise in housing other than the single-family detached fee ownership type that we all think of when we think of as home ownership. Conrad will be followed by Karen Morrell. She's a senior research fellow at the New America Foundation, a colleague on our Financial Services and Education Project, and founder and president of Higher Heights Consulting and Training. Karen's recently authored You and Your Money, a no-stress guide to becoming financially fit, and I do recommend it. Next, we'll hear from Ken Wade. Ken is CEO of NeighborWorks America, which is the national support organization for more than 240 housing and community development organizations. Some of you may have known it as NeighborWorks, as Neighborhood Reinvestment Corporation. Ken has a long history in community development, and NeighborWorks America has recently been at the forefront, and Ken has been the big spokesman for the National Foreclosure Prevention Program and its, take this down, 888-995-HOPE hotline. He'll discuss that and other NeighborWorks and what other work NeighborWorks and its affiliates are doing to make sure that homeownership, especially for low-income families, is sustainable. And then we'll conclude with Josh Nassar, Vice President for Federal Affairs at the Center for Responsible Lending. As many of you know, CRL was one of the first organizations to not only blow the whistle on excesses, but to do strong research and get laws changed to fix the problem. They're a major force behind the new North Carolina law on predatory lending. Each of our speakers will take about 10 minutes, and then we will have plenty of time for questions and discussions, and we really welcome your active participation in this program. Thank you.
Good afternoon. Everybody had a good lunch. Feel free to get up during any and all of the presentations and get some more if you'd like. Thank you, Ellen, for bringing us together and the others who were in the leadership of that effort. And it's a great privilege to be here. As Ellen indicated, I'm Conrad Egan, President of the National Housing Conference. And my job is to kind of start at the front end, and then we'll gradually work through the process. And while much of the emphasis today is on foreclosure prevention, I think that it is also important that we talk and learn and support long-term sustainable homeownership. And that starts with a good entry into the world of homeownership, and not the kind of entry that unfortunately we've seen all too frequently in the last few years, where borrowers are stretched and pulled and tugged and yanked in various kinds of different directions just to barely get over the threshold and get into the home. And anything that goes wrong can shatter that whole situation, including resets, including unexpected repairs, including just unanticipated events. So it's therefore important to think of homeownership not just as an outcome or an event, but also a process. Let me just quickly walk you through the steps in that process. First of all, it starts with savings, and then repairing credit if necessary. Understanding the home buying process. How many of our particularly recent first-time homeowners really didn't understand what they were getting into? And also then finding the right home at the right price, in the right location. Finding the right financing. And then actually going through the purchasing process. But then learning how to budget to maintain the home. We're talking about sustainability here. Understanding how to keep the property in good shape, and then understanding various, shall we call them, escape options, refinancing techniques and tools in case things start to get troublesome. I like to think of this as a ladder whereby various income groups, particularly low-income families, can begin to build the kind of equity, the kind of savings to get on that ladder of sustainable home ownership. And that includes the following elements. First of all, how can we encourage savings? Mr. English already mentioned individual development accounts. That's certainly a good way to do that. The Family Self-Sufficiency Program is another very good way to do that. Also, we need to focus on education and counseling, and some of my colleagues will talk more about that, including credit counseling, homeownership education, financial literacy education. We should look at innovative financing techniques. I'd like to just mention two, one of which is the shared equity financing. I'll talk a little bit more about that in a moment. And then responsible lease purchase arrangements. So I think we've heard too much, and I know Josh is very familiar with irresponsible lease purchase arrangements. But I think there are ways to structure transactions that through that particular device. Let's also think about employer-assisted housing, where employers are encouraged to help their employees afford homes, both rental and homes. And I saw my colleague Dave Brown come in a few minutes ago. I want to recognize Dave for the good work that he's doing through the National NeighborWorks Association. And I see you brought some of your colleagues with you here today to support, introduce and support two pieces of legislation which are, when enacted, going to provide a tax credit to the employers at the federal level to encourage them to help their employees get into homes and to be able to afford those homes. So keep your eye on S-1078 and HR 1850. They are working their way through the Congress, and we have high hopes that they will be enacted and will provide yet another tool to bring the employers into this action. We also need to think about increasing the supply of housing. Why is housing so expensive, and why do people have to stretch so far to get into a home? A lot of it is because of the supply. There's a lack of supply. Why is there a lack of supply? A lot of that is regulatory barriers at the state and particularly at the local level. And then, of course, fair housing. Before I wrap up, I just want to dwell a little bit more on the shared equity concept, because what this involves is a sharing of responsibility and benefits between an entity that's providing a subsidy to a homeowner and the homeowner. Basically, the deal is like this. We'll help you buy that home, but when you sell that home, we want to have an arrangement with you whereby we share the equity. So yes, you get assistance up front, but then at the back end, you end up sharing that equity. And that has another very important aspect, because it ensures the long-term affordability of that home, either through some kind of general community-based, like community land trust arrangement, or through an arrangement with that specific home. So I would encourage you to go to our website, nhc.org, and we've recently brought out a series of products in the shared equity area, and I would encourage you to take a look at those as devices. One of the things that Congress could do would be to encourage FHA to enact on a pilot basis, to implement on a pilot basis, some of those shared equity techniques and tools. They are also applicable, by the way, and I was very pleased to see Mr. Dugan, the Comptroller of Currency, recently point out that at the point of workouts, and particularly where you're bringing in employer assistance into those workouts, that you can implement a shared equity approach at that time. So let me just close, if I could, Ellen, with a few quick comments on a recent publication that we have produced. And by the way, this publication and others are sitting over there on the table, so if you came in early and you didn't get this, please get one on the way out. We're now into our 8th year of examining the America's Housing Survey, which comes out every other year. So this particular publication looks at the challenges facing America's working families, the housing challenges facing America's working families from 1997 to 2005. And it's very simple and easy to read and understand. A lot of bar graphs, a lot of charts. I want to thank my colleague, Maya Brennan, who's with me here today, who had a lot to do with putting together that particular publication. And I want to just point out one particularly maybe surprising finding, that it is the renters who have had the greatest increase in housing challenges over this period of time, particularly within the last 2 to 4 year cycle. And the consequence of that, as it loops back into home ownership, is that if you are paying more than half of your income for rental housing, it's going to be really, really difficult for you to build up the equity, to build up the good credit history that's going to enable you to get a good FICO score and to get into a good home at a good rate. So this is all tied together, both rental and home ownership. So let me stop there. Thank you.
When Conrad started his presentation, he talked about the importance of working to help consumers get started on home ownership the right way. So I'm going to follow in that theme, Conrad, and I'm going to talk a little bit about home ownership education and counseling and how that can help create sustainable home ownership. So I'm going to talk a little bit, just to give you a general background about home ownership education and counseling, and then I'm going to point to just a few of the specific ways home ownership education and counseling can help create sustainable home ownership. For the purposes of my remarks, though, I'm going to focus solely on pre-purchase counseling. I think you'll hear a little bit more about some of the things being done post-purchase, but I'm going to focus on pre-purchase. The goal of pre-purchase homeownership education and counseling is to prepare families for homeownership. It's to make sure that they understand the responsibilities of homeownership, to make sure that homeownership really is the right choice for them at that point in time. There are a range of topics that are covered in pre-purchase homeownership education and counseling. Everything from basic money management, where the families are able to assess their financial situation and figure out if they are financially in a position to buy a home. Credit management is another key financial topic where consumers actually look at their credit, figure out if they have any credit issues that they need to resolve before moving into homeownership. Homeownership education and counseling also talks about the process of finding a home, shopping for a home. It also goes over the mortgage process, the process of obtaining a mortgage. So not only how to find a lender, but it goes over the different mortgage products that are available and helps people assess the differences and figure out which is best for them. It also talks about the closing process, gives consumers an understanding of what to expect during closing, what kind of documents will be exchanged during closing, and then also life as a homeowner is another segment of homeownership education. And this gives consumers an understanding of the responsibilities of homeownership and what they can expect once they actually move into the home. And that's an important piece because often when consumers go to homeownership education and counseling, their goal really is to get into the home. So they're very focused on that goal and may not be looking beyond, once they get the goal. But it's important that they begin to think about not just becoming a homeowner, but what their life is going to be like beyond that, and making sure that financially they'll be in a position that they'll be able to sustain that home over time. So the information that I just described can be delivered either through education or counseling or through a combination of the two. And with education, the goal really is to increase the participants' knowledge, maybe to build skills in those different areas that I just mentioned. And it's usually delivered in a classroom setting or through workshops. Sometimes it's offered online or through self-study. Information can also be delivered in one-on-one counseling. And in these situations, counseling is often tailored to an individual's specific situation. So for instance, if they have a specific issue that they need to correct before moving into homeownership, one-on-one counseling gives an opportunity to work with a counselor, develop a specific plan to achieve that goal before they move into homeownership. And this is generally done face-to-face, but can also be done via the telephone. It's more time-intensive than the education, and it's also more expensive to deliver. When we look at the effectiveness, or what's the end result of going through this process, do the consumers end up any better by going through education and counseling? Probably the most frequently cited research study around that is some research that Freddie Mac did. They looked at about 40,000 of their loans made through the Affordable Gold program, and they looked at the consumers that had gone through homeownership education and counseling. And what they found was the most significant impact was for consumers that had gone through the one-on-one counseling. For those consumers, they experienced a 34% reduction in their 90-day delinquency rate. So that showed a clear connection with the education and counseling and the ability for the consumer to pay in a timely fashion, which is clearly linked to avoiding foreclosure. Just some of the specific things that I want to talk about in homeownership education and counseling that help create successful homeowners over the long term. One clearly is the budgeting piece, but the importance of the budgeting piece is it's important to establish a budget up front and make sure you can afford home ownership. But equally important is to look at that budget and factor in all the additional costs that come with home ownership. When you become a homeowner, you generally have increased costs with home repairs or keeping up with home maintenance, sometimes increased utility costs. These factors need to be considered in the budget so that the consumer makes sure that once they get the home, they'll be able to keep up those expenses over the long term. Related to that, though, is the establishment of an emergency fund. Making sure that your budget has some cushion in it so that if a crisis does arise, you do have some money to fall back on. And this is particularly important for some of our lower income families who maybe have less resources to look to, at least if they have an emergency fund. If a crisis comes up, a gap in employment, a family emergency, they do have some money to turn to so that that mortgage payment can continue to be paid. Another area is a more enhanced focus on loan products. There's a variety of very complex loan products in the marketplace today. And it's not sufficient just to kind of give an overview of the products that are available, but it's really important that consumers understand the long-term implications of those products. So not just making sure that you can afford to get into the product, but making sure that if the rate changes over time, you can still afford that payment. And if you can't, what are some of the other product options that you can consider? And lastly, I'll just talk about the information about understanding what your options are if you have trouble paying a mortgage. There have been surveys that show that as much as 40 to 50% of the people that are in foreclosure didn't contact their lender or servicer simply because they didn't realize there were any options available to them. It's important that through homeownership education and counseling, they realize that there are resources, whether they go back to their counselor or at least to contact their lender or servicer as soon as they think they're going to be having difficulty, because the later they wait, the less options that there will be available to them. So that's an important point that needs to be made through counseling. So these are just a couple of the ways that homeownership education and counseling can work to create homeownership that's sustainable over time.
Thank you, Ellen, and I'm glad to be here to just talk a little bit about our experience in this area. I'm Ken Wade, CEO of NeighborWorks America. Ellen, in her introduction, didn't tell you that when she served as the director of the Office of Fair Supervision, she served on our board, and knows our homeownership work well, because I think she was our board chair when we launched our second 5-year homeownership effort. We've been involved in promoting homeownership as a defined campaign since '93. During that time, members of our NeighborWorks network, a few of whom are here today, have counseled over 700,000 families. They've assisted, of that number of families, over 150,000 of low and moderate income families to get into homeownership. These families are pretty similar in characteristics to what are described as subprime borrowers today. 92% of them were first-time home buyers, 91% were from low and moderate income families, 53% were minorities, and 41% were female-headed households. If you look at the performance of the loans that we track from the folks who were assisted from our network, even though they're very similar to subprime borrowers, their loan performance, they are 10 times less likely to go into foreclosure than subprime borrowers, 4 times less likely to go into foreclosure than FHA borrowers, and slightly less likely to go into foreclosure than prime borrowers. Now, some might ask, how can you get that kind of result with the same kind of customer when you compare that to what's happening in the subprime market? And when we kicked off our homeownership campaign back in '93, one of the things that our network organizations developed is this concept of full cycle lending. And building off of what Karen said, the cornerstone of that is quality pre-purchase counseling. You know, it's the old adage, you know, an ounce of cure is better than, an ounce of prevention is better than a pound of cure. Clearly, consumers who are armed on the front end about the home buying process have a much better chance of being able to sustain home ownership. Coupled with that, many of our NeighborWorks organizations have access to flexible loan products, some of which are provided by our own secondary market, some of which they develop with their own lender partners, to ensure that the type of loans that are going to be available to the consumers they serve are the loans that will be in the consumer's best interest. In addition to that, a third component is the property services. As you know, many low and moderate income consumers are going to buy houses at the low end of the market. Many of those houses need property improvements. Many times consumers get into trouble when they become homeowners because they can't afford to do the improvements that are necessary in order to stay in their home. So our organizations typically provide property services, whether that be construction management services, and in many cases do loans to those consumers to help them with homeowner rehab. And then staying with that consumer over time through post-purchase counseling. That's a hallmark of our effort, and all of our organizations are available for those consumers who get into trouble. But that notwithstanding, and our experience, I think, is similar to self-help, credit union. You'll hear from them a little later, and other organizations that do this type of work. I think we can demonstrate that you could serve consumers that may not be of the same credit quality to qualify for prime loans, and you can do that responsibly, provided you give them good information, are able to provide them with good loan products, are able to help them on the property selection side, and are able to be there for them on the back end. Now, one of the challenges we have in the mortgage market today is that counseling isn't broadly available to everyone. And that's a challenge that I think that those of us working in this field have to deal with. Here in DC, as an example, there are probably 50, 60, I don't know, maybe 80 groups that provide that service here. But if you're in Gaffney, South Carolina, as an example, you may not be able to get that service. So I think that's a challenge we have to respond to. In addition to that, we've, in looking at this issue based on feedback from our members, have recognized that we had to step up and play some role on the current mortgage crisis. So we are working with an organization called the Homeownership Preservation Foundation. We have a national hotline that's out there. It's available 24/7. Any consumer that's having a challenge paying their mortgage can call that number now. Counselors are available 24/7, both in English and in Spanish. They're connected with counselors who work with them on their specific issues. For those people who can't be helped at the telephone level, they're referred to local community-based organizations around the country, many of whom are NeighborWorks organizations. We found that that's an effective way of addressing the problem. It's based on a model that our NeighborWorks organization in Chicago developed, the Homeownership Preservation Initiative, and we've been able to successfully demonstrate that you can serve this consumer. The hotline's been up and running for a little over a year. Last year around this time it was receiving about 390 calls a day. Today they're receiving almost 2,000 calls a day, obviously in response to the challenge that's out there in the mortgage market. So we're also launched a national public education campaign to reach out to consumers to get them to contact the hotline or other local community-based organizations that can provide this kind of assistance. It does feature the hotline, 1-888-995-HOPE, so anyone can call that number today and get that assistance. But it also is an attempt to do one other very important thing. From the research we've done and others have done, many times those consumers who do reach out for help, and actually Karen mentioned one very important point, most of the lenders will tell you up to 50% of consumers who go to foreclosure every year never have any contact with their lender. They just allow the event to occur. They don't reach out to anyone. Some additional number of people, when they do finally reach out to either their lender or to community-based organizations, they're far too delinquent for you to be of much assistance to them. So one of the goals of our public education campaign with the Ad Council, and one of the signature ads is called Every Minute Counts. And basically it urges consumers to reach out to assistance sooner rather than later so that they can avoid foreclosure. Just to give you a little sense of who are the incomes of some of the people who are calling, there was clearly, this is concentrated with certain populations and with certain income groups, but it is a widespread problem. Last quarter, the hotline got 30,000 calls. Of those 30,000 calls, 30% of those consumers made $50,000 or more. That's an annual income. And of that group, 11% of them earned $72,000 and above. So while clearly the problem is concentrated in certain populations and income groups, it is a widespread problem, and I think Ellen touched on that in her remarks with some of the challenges we've seen in the high-cost markets where people may have gotten into homeownership opportunities using some exotic products to afford the high-cost houses have gotten into trouble. So we're seeing a lot of foreclosure numbers coming in from places like California, Massachusetts, Florida. I said prior to that, the past few years, it primarily had been concentrated in the industrial Midwest. So we think one of the downsides that we would hope would not be a result of this mortgage crisis is for us to come to the conclusion that you can't serve people who might have a credit blemish, who may be limited on income, because housing still is and will continue to be probably one of the most important asset building tools available to us. And so to a certain extent, we wouldn't want to come to the conclusion that that's no longer a valid thing for us to focus on. So thanks.
Well, thank you very much, Meltdown, for inviting CRL here today. And my name is Josh Master from the Center for Responsible Lending. Center for Responsible Lending is a nonprofit public policy advocacy group that works to encourage responsible lending and protect low-wealth families' precious assets. We are an affiliate of Self-Help Credit Union, which is based in North Carolina, and over the past 25 years, has helped over 50,000 small business owners, homeowners, achieve ownership and serving $5 billion worth of loans. So the reason I give you the background is because we are strong believers that homeownership can be a tremendous wealth-building tool. And I think it's important to point out that for most Americans, most of their wealth is in their home. And for African American and Latino families, it's by far most of their wealth is found in their home equity. We're talking about roughly 90% for Latino and African American families that their wealth is in their home. And it's important also to point out that there's a tremendous wealth gap. I'm not talking about income, but wealth between minority communities and white communities. Minority communities have roughly a fifth of the amount of wealth as white communities. So when you're talking about home ownership, when you're talking about abusive lending, the repercussions are really widespread for everyone, especially hits hard in communities of color. Now, we released a report, so I want to talk about the subprime market, what we can do to improve the subprime market so it can be a positive wealth-building tool. But I need to talk a bit about the past and where we've been. So the subprime market has grown tremendously since the early 90s, and it has become a market until recent time that was well over $600 billion annually. So we've seen this market that it's mostly, subprime loans are mostly refinancing still, and it's important to point out over the past 10 years, about 10% of subprime loans have gone to first-time home buyers. So most subprime loans have been refinancing, and a lot of times it's folks moving from one place to another. Now, in the past few years, over half of African Americans who have received mortgages have received a subprime loan, and over 40% for Latino communities. For the white counterparts, it's less than 20%. Now, in the past several years, the dominant subprime loans have been very problematic. They've been referred to by several of the other speakers as ones with teaser rates, and I want to explain that a little bit. The dominant subprime loans have been hybrid ARM loans, which means that a person receives a fixed rate, so let's say a 228, that's a 30-year mortgage. The first couple of years, the person receives a fixed rate. And then, entering the third year, it becomes an adjustable rate mortgage. The problem is that most of the subprime 228s have a built-in payment shock of well over 30–40%. And the reason why is because the rates, and that's not with an increase in inflation, by the way. And the reason why is because they've been linked to a LIBOR index, which is roughly 5.5, plus another index, which is roughly 6%. So what does that mean? That means that a person who, let's say has a mortgage that's $2,000 a month, all of a sudden after the second year, within a short period of time, they're paying $2,600. So that's a tremendous jump. The majority of subprime lenders have been only qualifying people in the past few years to the teaser rate. So they've been qualifying the person based on their ability to afford the loan initially, not once the adjustment hits. It's a formula for disaster. December this past year, we predicted that 20% of subprime loans made in recent years would enter foreclosure. At the time, many criticized us for being overly pessimistic. Now it looks like we were too conservative when you look at what's going on out there. And in fact, Lehman Brothers, looking at recent data, predicted 30%. So, but when you look at the loan features, it's not that much of a surprise. Now, as been discussed, when you had a decline, when you had a booming housing market, folks that maybe had a problematic loan had an escape valve. They could refinance because the value of the home had increased so much. But when the housing market slows down and you have these massive payment increases, that is really a formula for causing mass foreclosures. So the other thing about foreclosures I want to point out is that it's not only the value, the person losing their home and the equity they built in, it also has a very negative impact on communities. It really decreases property values for their neighbors, and when you have a cluster of foreclosures, it can really be devastating for a whole community. In addition, most of the 228s and 327 loans that were made, there was no escrowing for taxes and insurance, meaning that the borrower then had a tremendous tax or insurance payment due later in the year, which is very difficult to make. Most of the loans had prepayment penalties. I'm not sure how familiar everyone is with prepayment penalties, but roughly 70% of subprime loans made the past several years have had prepayment penalties, and the prime market has been less than 5%. So, if let's say you have a 2-year prepayment penalty, that means that a year and a half, if you wish to refinance, get out of your mortgage, get a new mortgage, you have to pay this tremendous prepayment penalty, which many times comes out of the home equity that you've built. So loans have had teaser rates, no escrowing for tax insurance. Many times they've been low doc or no doc loans, meaning that the person did not have necessarily the income to support the loans in the first place, and it was kind of done on very questionable grounds. And we have predicted that if you look at a longer view of what's gone on in the subprime market, that ultimately 2.2 million families will lose their home, costing $164 billion of wealth. Now, I know I'm giving some very negative numbers here and kind of painting a very dark picture, but I think if we're going to talk about how we change it, we need to have a clear understanding of what the problem is. So, kind of looking at what can be done. Well, one thing, and it's been talked about here, is what can we do to help a homeowner who is in a bad loan right now, or a loan that's going to have this massive payment increase. Of course, reaching out, encouraging the homeowner to reach out to the lender is a very important thing to do. But most of these loans that you have are sold into the secondary market, or sold into Wall Street. So what happens is a lender will make a loan, package it with, let's say, 10, 20,000 other loans, sells the security, it's sold again and again and again. So when we start looking at this problem, it seems to be very, very difficult to figure out who does a borrower go to, how can you get this fixed when so many different people are owning different parts of the mortgage. Fortunately, there's been some progress, and the SEC has issued a letter clarifying, and I provided the letter out there, that says that servicers who manage the loan at this part of the process have pretty broad latitude to modify the loan terms if there's going to be a foreseeable problem or default. And when you have such a massive payment increase in so many loans, you can argue that that's pretty foreseeable. So I would say that there are tools that are out there that people should be using for sure. But it's also, what can we do going forward to kind of prevent this from happening again? I think one thing very simply is a return to sound underwriting. To have it so a person receives a loan can actually afford the loan. And not just the initial period, but after. The federal regulators have moved in and have provided some guidance to institutions that are regulated here in D.C., so we're talking about national banks, thrifts, etc., to make sure that their institutions underwrite loans so people can afford the adjusted rate, not just the initial rate. So that's a positive development. We're hoping that the Federal Reserve will take additional action and make sure that it applies to the entire market, because a good deal of mortgages are originated by mortgage finance companies they're not banks, and they are not regulated by the federal bank regulator. So we need to apply to the whole market. We also need to look at kind of what happens in the loan transaction, especially in the subprime market, which in recent years, and it's obviously dropped recently, it's been about 25% of new loans originated. In the subprime market, over 70% of loans have been originated by mortgage brokers. Mortgage brokers are generally compensated when the loan closes, like the person in their home, done deal. In other words, the mortgage broker is not around 3 years later when the person, let's say in the 228 situation, has a real bad problem affording their loan. They have a financial incentive to close the deal as soon as they can. And we're not faulting mortgage brokers for doing that, but we need to look at the incentive structure. The fact of the matter is that for a long time, lenders have been paying mortgage brokers through what's called a yield spread premium, and I apologize for all the industry jargon I'm using here, which is essentially a payment for putting someone in a higher rate loan than what they qualify for. So in other words, it can be argued as a kickback. Okay, if you put a person in a higher rate loan, you're going to get a payment for this. So that's one. So you got to look at the mortgage broker, their role, the consumer, and their incentive structure. That has to be looked at to prevent this kind of thing from happening in the future. Another thing that has to be looked at is the interest of the lender with the consumer. Now, I don't know about you, but it's just kind of common sense says that a bank does not want to lend to someone that can't pay back the loan. Not because of altruism, but just it's common sense. It's bad business to lend money that you're not going to get back. The problem with that view of how the market operates, it doesn't match up to current reality, which is that lenders have been securitizing loans, have been selling them, packaging a couple of loans, selling them as security into Wall Street. Now, what that creates again is a incentive to close the loan, package it, get it off your books. Again, there are problems a few years down the road. It doesn't mean that the bank will really have to pay for that or be as concerned about the long-term performance of the loan. So you have to look at the incentive structures as policymakers, what we can do to kind of prevent this kind of thing from happening in the future. So just finally, I'd like to say that our website is www.responsiblelending.org. And again, my name is Josh Nasser, materials out front. I'll be happy to answer any questions. And really, it's important to emphasize that the subprime market has provided tremendous tools to folks, but that abusive lending practices have kind of eroded many of the value. We need to figure out how to kind of restore fundamental lending principles to the subprime market so it can play a more positive role going forward. Thanks for your attention.
We've heard a lot of different ideas, a lot of different perspectives, and some interesting policy prescriptions. And we're now open for questions.
I wanted to raise a broader, related to the mortgage crisis. My name is Chester Hartman's from PRAC, the Poverty and Race Research Action Council. I have a lot of doubts about the whole sort of glorification of homeownership. Conrad mentioned some very important aspects of it. The one that I want to raise is asset building. I mean, we glorify homeownership in large part because it permits the creation of wealth. Okay? And that's very important, obviously, for passing on to the kids, for retirement, for weathering crises. The flip side of that is that as all this wealth gets created through rising housing costs, rising housing values, it increases the affordability crisis for the rest of the society, which is the major housing problem now. There are tens of millions of American families that cannot afford both housing and the rest of life's necessities. And I'm wondering, from that perspective, what people in the panel might want to say about homeownership.
Can you go straight to that?
Well, I think, Chester, you make a very relevant point, and that's why I tried to say in my comments that we also need to look at improving the affordability on the rental side. And I agree that homeownership is, when particularly in recent times, I think the techniques that have been used to get people into homeownership have also served to raise prices. Because I think that what people have been doing is not necessarily buying less home at lower price, but they've been buying more home at higher prices, and that's been driving it up. I just want to emphasize the connection that Chester also made between the costs of housing and the cost of transportation. We put out a study recently, which is on our website, nhc.org, called Heavy Load, which documents, and again, I think this is somewhat surprising, that we looked at about 30 different metropolitan statistical areas. And surprisingly, no matter where you are, if you're in Philadelphia or if you're in San Francisco, moderate income working families are going to be paying 60% of their, roughly 60% of their income for the combined cost of transportation and housing. So we need to look at both of those together, I would expect. And that has tremendous implications for land use policy and also for transportation policy.
Looking into that, first of all, that study is part of a broader study that attempts to get away from the sort of 30% of income rule on housing and say we need to look at both of these together. And there's work on Conrad's website, there's also work on the Brookings website, work on the Center for Neighborhood Technology's website. They're all working together on this problem, and it really is an important connection. But Conrad, I wanted to ask you something which I emailed with your colleagues about, which is we're hearing that we're getting a lot of foreclosures, that a lot of those foreclosures are coming from investor-owned properties, so we're getting a lot of vacancies. How is that going to play into this need for additional affordable rental housing?
Well, I, first of all, don't think that there's going to be much of an effect, much of a major significant effect on the pricing of homes, be they either rental homes or ownership homes. I think some have suggested, I think Ken, you offered that there was some, and I think you too, Ellen, that there were some price drops beginning to occur in certain areas. But I don't think we're going to find that that's, at the end of the day, all that significant. What we have developed, and I think, again, the earlier comments touched on this, is what I would call a structural gap between the cost of homes, be they rental or home ownership, and incomes. And the incomes over the last 10 years, and these are just rough statistics, have risen by maybe 50%. The price of homes in many places has risen by 100% or 200%. And that structural gap is not going to be closed by a few vacant homes and a small drop in prices. But we're also noting that the flip side of the increased unavailability of home ownership options is that that's driving up rental rates. Because if you can't buy, you're going to go rent, and if there aren't very many affordable rental units available, the price is going to go up, and we're seeing that as a significant problem in many areas.
Yeah, I was just going to say that obviously we need all forms of housing to solve the housing problems that our nation has. We need supportive housing for those that need that. We need good rental housing for those people that need or choose that option, because sometimes people choose that even if they have the income to purchase. And then we need more home ownership opportunities. The reality of the affordability challenge is that it's across the board, rental and home ownership. And I think that's really a function of prices both on the purchase side and rents rising faster than incomes. That's been a phenomenon we've been in for the past, 15 years or so. It's somewhat unique in our history. So that's why you find both on the rental side and the home ownership side, people who historically hadn't been considered folks who had a challenge on the affordability side, part of that group now. You know, teachers, firemen, people who do the service jobs in a lot of our cities can't afford to live in the city they live in, whether that be renting or owning.
Greg Squires, George Washington University. This morning there was an interview on National Public Radio with a recently fired loan officer who made the point that just because lenders make a product available doesn't mean a borrower has to take it. And her argument was the real problem here is that a lot of people are taking loans that they simply should have known they couldn't afford. And this, as everyone in this room knows, this is a pretty popular argument, strikes me as a classic victim blame. But unless this argument is countered, I think it's going to be much more difficult to get any kind of legislation through or regulatory change in the Fed, or to get private lenders to do anything different. And I'd like the panel's suggestions on how this definition of the situation can be challenged.
I'm going to tell an anecdote before I ask my colleagues. I'm sure Karen and Ken and Josh want to talk about this. A major, very reputable finance bank has been publicizing that they are going to lower their rates on 30-year and 15-year fixed rate mortgages so that people can refinance their arms into these mortgages. So I go on the website and I go to the little loan calculator and stick in some very respectable numbers. I did a jumbo and a non-jumbo. And what comes up first? A 5-year interest only arm. I mean, you know, something about how marketing is done and the pure behavioral economics, which a lot of us have been thinking a lot about recently, of when you go in and ask for a 15-year fixed rate mortgage or 30-year fixed rate mortgage and the mortgage broker hands you the interest only mortgage and you have to fight to get the other loan. The fact that the other loan was available is a lot less powerful, but I'll ask my counseling colleagues to talk a little bit more about that. Karen.
Yeah, I was actually going to say something very similar, that that's kind of an easy response, but the playing field is simply uneven when you think about it. When you look at the complexities that products have, yes, consumers have a responsibility to understand what they're getting into, but I think that the way the information is delivered is not always easy for consumers to understand. And that that's an easy way out. I don't think that's the answer. I think consumers do need to be mindful about understanding the long-term implications. That was the point that I tried to make about understanding, you know, the terms of the loan and if they're going to change. But to simply say that it's the consumer's responsibility solely without looking at the availability of, you know, responsible products that are suitable to the consumer, I just don't think that's I think that answer is the easy way out. Not
My question is, how do we counter that? I agree with you, that's the easy way out. What do we do collectively to counter this widespread belief?
Okay, Josh, I think.
Yeah, I think that's a great question. I mean, I think one thing just to look at is talking about the borrower responsibility, homeowner responsibility, is that no doubt they have responsibility and no doubt they are paying a severe price for these abusive loans. And I think what has to be talked about is the way the transactions actually happen. Frequently, what homeowners told about is, you know, the lowest monthly payment, and talking about, you know, options for refinancing, and to kind of, you know, there might be money immediately, might be a cash out refi, and it's, hey, you know, I can get you this mortgage for this amount. And looking at the lender and broker responsibilities has to be an important part of changing the policy. But the short, I guess, answer is that homeowners are bearing a great deal of pain for the situation now. So the idea that they're not bearing responsibility flies in the face, you know, the foreclosure rates.
I would just add that because of the way the mortgage market works and the disaggregated interests of all of those people who play a part in it, back in the old days, so to speak, you know, the person that originated that loan, serviced that loan, and held that loan. Well, today, those people are not the same. The person that originates the loan is some independent player. In most cases, that loan is made, someone else services it, and it's sold somewhere else. So the challenge that the consumer has today, it's also a market that's very hard to comparison shop. Yes, you can go on bankrate.com and see what interest rates are, generally speaking, but that won't necessarily be the interest rate you will qualify for. And a consumer has no way practically of being able to understand that. And if you've ever seen a subprime pricing sheet, you need to be you have to be a math major to figure it out, because it's all tiered with a number of different combinations based on the loan to value that you're going to have with the house you buy, your credit quality, and a bunch of other characteristics. So you really don't know the loan you have until you show up at the closing. Because even the good faith estimate you get says at the bottom, don't pay any attention to this, because when you get to the closing, it can be different. I mean, so the reality is, yeah, you could go get a bunch of good faith estimates, and there are too many stories of consumers showing up at the closing, and it is different. Because there are some legitimate reasons for it being different, and then there are some things that happen in the transaction that aren't in the consumer's interest, that the consumer's just not aware of. So it's a very complicated process, and it's very hard to comparison shop.
Just a quick additional comment building on particularly what Ken just said. I think, Greg, your point is very well taken. I think the message we need to get out is that the system that was developed and was permitted by the regulators, yes, by the regulators, to flower and flourish over the last few years, was designed from an incentive standpoint to produce the outcomes, exactly the outcomes we're now experiencing. The brokers were compensated for driving up the rates, getting these people into these ninja loans, no income, no job, no asset. The lenders, as many have pointed out, could get rid of the loans, they could sell them off to Wall Street, and the hedge funds didn't care about anything but yield. So the whole system was designed against, it was stacked against the borrower.
Yes, my name is Nelly. I am a housing counselor. I've been in the housing industry since 1984. My question here, I had the comment that Mr. Davis said that we have a shortage in the housing, you know. I would say to that, I don't know what, I'm sure you directed at is affordable housing, what is we are short of, because housing, we have them today, they're not building, they're planting, and they just come up, but they are prices that our buyers as counselors cannot afford those houses. So housing is plenty now. There are no places where they cannot sell those houses because they're building too many, but we need the affordable housing. And on the other side to Mr. Nasa, my opinion is that all this is connected to the lack of regulation for the lenders. As counselors, I have counseled people from the high price houses to the very first time home buyer that had to go a year preparing them to get them to buy. Okay, so we have seen them all. But as long as the lenders are not regulated totally, and that unfortunately our representative left, they are the ones that we quote all the time, because like here in the District of Columbia, we have the example, the banks are not regulated like the mortgage companies are. So the mortgage company just took off. They leave the district, and since we have interest rate lending, they just go somewhere else and they lend to the district from somewhere else. So this is the problem that we have. We have to control these lenders, because the work we do as counselors goes so far, but many people are so smart anymore, they go on the internet and they look their own prices and they say they have the best, but they also should have the counseling. That is what your association should do. The New American is doing great, and so are you. So we have to insist on the lenders to cut down this, not be allowed to do, because you know the innovative financing come in all ways. Every 4 to 5 years they have something new. They stop it from one, they have something new. So we can't keep on allowing that to happen, because all the problem we have with foreclosure has to be solved before it starts. That's the foreclosure situation.
Thank you very much. Ken, I asked Ken earlier before we started here about the experience that whether this whole episode has changed what had been happening quite a while with the counselors, where they would do a lot of counseling, but then people would run off and get loans of their own. So why don't you talk a little bit
Sure.
about
I mean, one of the experiences we've had, having been working with a network of community-based groups who've done counseling for years, as the subprime market grew, there was a dynamic at work that discouraged consumers actually from seeking counseling. And that was, again, driven primarily by brokers and real estate agents who, I understand how it works. They can't get paid until the loan closes. So they would say to consumers, don't worry about that counseling. I can get you a loan today. But that loan was often a loan with a teaser rate or some kind of option arm. Now, yeah, that was maybe a way to get into that house, but it was a temporary, at best, solution. And so part of the challenge with the home purchase process today, when you think about it, you know, I don't know when Consumer Reports made that breakthrough when they started offering the service to give you the pricing on an automobile. You know, back then, nobody knew what an automobile cost unless you had an uncle or somebody who worked for a car dealer. It was a total mystery. You could walk into that car dealer, you had no idea what that car cost. That's what shopping for a mortgage is like today. And we need something similar to that so that the consumer, whether that be through some variety of tools and or better access to what I'm going to call a mortgage advisor rather than a counselor, because I know sometimes counseling can have a somewhat of a pejorative term. So people don't seek counseling unless something's wrong with them. But however, just like when most people purchase a home today, they know they don't know enough about construction to make a decision without going to get a home inspector. I think mortgage lending has become so complicated. Most consumers, whether that be on a purchase or a refinance, need to seek assistance from someone. I think we need to do all the fixes on the regulatory side. But it's still a very complicated market. And I think to a certain extent, it's very hard to shop and be armed as a consumer in this market.
Yes.
Yes, for all of you, do you think it's time to establish minimum educational standards for mortgage loan officers? There are none now. If you're a real estate agent, you have to take a certain minimum number of hours and pass an exam. If there's no standards for mortgage officers, and I'm wondering, in order to give good counseling, even under the best of intentions, as complicated as many mortgages are, should there be some minimum educational?
And that's the easiest question we've had today. Yes. But in addition, first of all, it has to be relevant education. And second, we need some licensing and testing and some sort of a registry. And I also believe, you know, securities brokers do very nicely with the suitability standard. Some of them go bad. Yeah, there are bucket shops and ugly things, but it's a lot better than what we have in the mortgage industry. Do any of my colleagues want to disagree with that? Or we'll just ask for another question? Okay, we'll ask for another question.
Ed Berger, you alluded several times, each of you, to the issue of the secondary market. And it seems to me the picture that's been played out over the last several months, for some time, is a prime mover being that the financial put pressure on banks to turn out more and more loans that they can buy. Be very creative. I listened to Susan Bai several years ago, Fed director. He talked about the enormous amount of money in securitization. No regulation at all. It seems to me that this picture will get nowhere without doing something about that.
Yeah, that's a great question. I mean, I think that the part that we take a hard look at is the responsibility of the market, the secondary market, for the loans that they purchase. And I think what has to be looked at here is this kind of passive look. I mean, as far as you know, it's referred to in the debate as a signing liability. And I think that there has to be, not only for the homeowner to be able to know who to go to, you know, if they're going to foreclosure, but beyond that, there has to be a self-policing that we have not seen in the secondary market. The other thing is there's a lot of talk about, you know, conflicts of interest with credit agencies, rating agencies, and that whole sphere too. But definitely looking at some responsibility, important responsibility for the purchasers of the loan, so you don't have this kind of passive decline.
Ellen, just a quick comment. Also, I think we need to strengthen the competition. We need to get FHA back in business. Ginnie Mae, where's Ginnie Mae in all of this? I mean, they could be a tremendous securitizer. Once again, the GSEs. I mean, a lot of argument about the GSEs one way or the other, but my gosh, let's get the damn reform legislation passed and let's get them back on their feet again.
Another question? Yes.
Hi, my name is Mark Samet. It's funny, I'm kind of a young guy, so my parents bought their house back in the 70s for about $50,000. Now it's worth, well, it was worth about $500,000, but now it's yeah, right now things are changing a little bit. But as a consequence of that, we've been able to, they were able to put 4 kids through college, have 2 cars, do the whole thing. We look at our generation, and my generation, things are a little bit more uncertain. And I guess my question is, are we going to, it sounds a little bit like we're building a nurse's office for like a grade school, but maybe what we're dealing with is like a war zone, and we need like an emergency room. And so my question is, like, if these houses have been used as assets for families all across America, and if there's been a tremendous amount of leveraging going all the way through the banking system up until the Pirates of the Caribbean hedge funds, what kind of effect is a collapse in the mortgage market? I mean, Mr. Nasser said something like 2.2 million could actually cause a much bigger crisis than that. An economic crisis that would bleed into the consumer markets. I mean, how do we deal with that?
I think none of us up here are actually economists, although I sat with one yesterday who intended to answer this question, and with an extraordinarily pessimistic view, which was that that housing prices are going to continue down in a spiral that will, in fact, generate a very negative result across the board. I'm not entirely sure. I think fortunately we're going to get saved by the bell here, because I don't think any of us have an answer for this. I would like to point out something though. Your family bought their first house in the 70s. I actually bought my first house in the 70s. And until we got to 1995, the way house price appreciation and the way people built assets for housing, there were 2 things. First, you actually paid off your mortgage. So you built equity through the forced savings of every month paying your mortgage. And the second thing is there was modest house price appreciation that was sort of in line, although at various times better than and at various times worse than, the general price levels of that were changing in the country. Starting in 1995, we had this wild spike, and after 2000, it got even worse. So I think that to some extent, and your family probably sent several of their children through school on the earlier piece, not the later piece, and on having paid off their mortgage. So I think to some extent, we're overreacting to a bursting of something that if we went back 6 years ago, and certainly if we went back 10 years ago, would have been completely unthinkable and totally abnormal. Now, how we deal with it will be a difficult problem and something that we're all going to have to work on. But I really do think it's important to put the last 10 years into, and particularly the last 5, into perspective. And with that, I'm going to thank you all for coming.